So let's move forward. We're going to go ahead and start on some commercial real estate updates as it relates to Houston, go through that, and then we're going to have our guest speaker here in a few minutes do an update on the economy and all things fun. But we're going to start with a quick video on Houston. All right, if that doesn't get you excited about Houston, I don't know what does, right? No, in all sincerity, look, there was a lot of information that we threw out there in that video. We're going to be sharing this out so you can see it, but if you want to take all of that and summarize it in this quick little overview, there's a lot of number ones, a lot of things that were in that top 5 across Houston and that we're known for. One of the things, if you saw, I think the Port of Houston announced earlier today or this week, 53 million tons of cargo through the port, which was a 6% growth year over year from last year. So all that means is, from a real estate standpoint, more product coming in, more people coming in, more activity going on, and it just continues to set Houston, obviously, in a very good light. And there's a bunch of other things to be proud of. 4th largest population in the country, 7.5 million people, we have 3.5 million employment base, and growing. And so big picture from just overall what to be proud of. Obviously, there's a lot of good things happening here in Houston. We wanted to kind of give a little plug, be open with you on this. We spend a lot of time in the research world, and so our research teams across the country, as well as in Canada and in Mexico, we obviously know the World Cup is coming here in 2026 across those regions. There's 16 different host cities that are going to be hosting the World Cup before the final match is done in, I believe it's in New Jersey. And so all of our research teams across these markets are going to be putting out different reports that shows the impact of the World Cup as well as what economic drivers are for these cities. So if you are a soccer fan and you are kind of all into this and you're a real estate fan, you want to get really nerdy around data with real estate and soccer, this is the place to go to. So go ahead and visit that when you have some time, but it's a cool way for us to kind of bring what's going on in our world in a place obviously here that's part of the whole hosting of the World Cup coming up here as well. So getting into kind of Houston, quick updates. I'm going to go through first kind of big picture. We'll get into each of the asset types and talk about what's the trends going on there. And really started with the relocation, population growth, and how that's coming into Texas. And when we were up here for the past 7 years, Texas was #1 7 years in a row. And unfortunately, it's not like it's bad, but South Carolina beat us out this past year. So we went to the lowly #2 spot, but I think it's still pretty good to say we're still the top 2 spots. And this is based off of U-Haul data of one-way, essentially, moves. So people that are moving from one state packing up that U-Haul and only going to another state, and that would be here to Texas. Who can guess was the lowest on that ranking? California, no surprise. What about 49th? New York. Who said New York? I heard New York. So it's really good, obviously, from us from that standpoint. Population growth continues to happen. And from a single-family residential sales standpoint, a lot of markets across the country have had their challenges, and they've seen a little bit of decline around sales as well as pricing. Here in Houston, as you can see, we still had about a 2.5% growth in pricing. Our average tends to be about 3%, give or take. So we're just on par, maybe slightly down, but still seeing, obviously, overall growth. And the top line there, the 1.3% growth in just overall single-family homes. And that is just driven, obviously, by this continued population growth that we have. From a retail standpoint, all of those consumers and all those people moving here, but the people here, they keep spending. I love this little quote here, right? Consumers keep spending, the retailers love it, and so do our retail brokers too. But overall, overall, keep spending in the retail world, and that's going to be the main driver around retail right now. Now, I will say vacancy has gone up slightly, right? So we're up at 5.4%. But I think it's really kind of about how you look into the data and what that actually is seeing. And at the bottom here, you'll see I have these store closings and different logos. It's not necessarily that vacancy has gone up because we've either had more product being supplied to the market or we're seeing a lot of tenants leaving the market. Basically, this whole transition that's been happening over the years with retail and the experience and some of the retailers like Macy's and Walgreens and CVS that have not maybe adapted as much as other retailers have, those are the ones that are closing, and there's still a significant amount of retailers opening. So this year, past year, we had 8 million square feet of leasing activity that happened in the city. That is the third highest in the history of the city in terms of overall leasing volume, and the only ones that beat it was 8.1 million and 8.4 million. So from an activity standpoint, sure, we see vacancy go up slightly, but from a just overall activity and growth, the numbers continue to support, obviously, a good retail market. There's a couple other things here that I've got in terms of just overall retail sales, and so the retail sales keep going up 3.9% year over year. If we all keep spending, we all love to spend, and Amazon loves us obviously spending, we keep doing that, that's going to keep the retail party going as well. From a retail under construction, though, there is a lot of dots on this map that obviously showcase there's a lot of construction happening, but here's the one tidbit of this. One, it's very costly right now to build anything. We all know that. We've heard about construction costs. Loans, obviously, and interest rates are high. But overall, there's only 6 properties that are under construction over 100,000 square feet. So even though we've got 40, 50 different dots on this map, they're all the small inline type of stuff, or they're freestanding restaurants that have been growing, and the overall activity. By the way, if you didn't know, from a restaurant standpoint, who here follows the Michelin guide and the star rating? Yeah? Did you all see that we have now finally gotten our first Michelin stars? 6 of them came into the city. So as a foodie city, I think it's now finally known outside of the city of how much growth that we've had. And having 6 different restaurants here be on the Michelin guide is a huge, obviously, plus from a retail and restaurant standpoint for the city as well. And that, obviously, growth that we continue to see. Overall, from an investment standpoint, I'm going to sound probably like a little bit of a broken record as it relates to investment because you're going to see the same trend happening in almost every asset type here in the market. We had a huge run-up after the pandemic, topped out in terms of the numbers way up there, and then past 2 years, we've just seen this thing fall off. Obviously, a lot of that's driven by interest rate growth that has happened. It's too costly to obviously buy. The sellers don't want to sell because where they bought at doesn't make sense to put their capital into the next one at these new interest rates. So there's definitely been this drop-off that's happened over the past 2 or 3 years. But what you're going to see time and again with each of these asset types is we're bottoming out. And so generally speaking, almost all of the asset types, and especially here in retail, you could see the trend going down, but then now it's starting to stabilize. And so even though we just had $1.6 billion of volume that happened, its average for us is about probably $2.5 to $3 billion of sales volume each year. So we're still below, but starting to pick back up from that standpoint. So just because the transactions counts down doesn't necessarily mean it's all bad when you're comparing it against an astronomical years that we had from 21 and 22, which I would just say is not normal from that standpoint. Shifting over to multifamily. So multifamily has been growing like crazy. Oversupplied probably is a good way to put it. Construction activity went through the roof from 21, 22 into 23. And so the whole "if you build it, they will come" saying was true, but it just took a little bit of time for multifamily to pick up in terms of the absorption. And so from a number standpoint, we've got 88% occupancy, which is up. We've got 18,000 units of net absorption, which is also up. And then our average monthly rate as well has gone up. Now our construction numbers, which I'll talk to in a second here, that is down, but that's, in my opinion, that's a good thing in terms of stabilization of this market, and that's what's basically going on around the construction. But if you look at number 2 up there and number 1, those two together, the main focus is a little bit of that flight to quality for residents. And so they are choosing to move out of some of the Class B and C stuff and move into the new stuff. And so from a year-over-year standpoint, Class A space, newer product has had a 25% year-over-year growth in absorption. And then overall, just absorption continues to be much higher, absorbing all of that product that came to the market. And so this slide gives you a good overview in terms of construction, of where it is at the end of last year compared to where it was at the end of the year before. And so I've got this written down here. So from a year-over-year standpoint, 25,000 units delivered in 2023 for the year. In 2024, we only had 23,000, so that was a drop of about 24%, give or take. And then from a units under construction, a significant drop, obviously, almost half in terms of the number of units under construction at the end of this year. Here's the good part. If you look at the proposed numbers, 34,000 now going up into 39. So when we talk about kind of that trough coming back down, now developers and interest is starting to peak back up. More stuff is proposed. We've gotten through some of the new supply that's hit the market and absorbed it, which has obviously given a little bit more of a brighter outlook in terms of the multifamily space. And the numbers here align on the investment side exactly to that. The big thing, though, from this standpoint, multifamily was probably the hardest hit when the interest rates started going up. So we had a 70% decline in total volume in terms of activity around multifamily investments from the peak in 21 down to what it was in 23. Again, going back to kind of the basic understanding of this, we typically would see about $4 to $5 billion of annual sales volume in Houston. So that number there, the white line, at $16 billion in 21, should just be erased from all of our minds. That's not normal, and that's not something we should ever say, oh, it's dropped off. Obviously, if you're in that space, it doesn't feel good, but overall, where we're at is getting closer to that normal of what we trend in this market going forward as well. The other piece I'll talk about on this is insurance cost. Insurance costs continue to be the biggest headache. When you've got fires going on in California, you've got flooding, you've got hurricanes, all of that is putting a big pressure, obviously, on the overall pricing. And I don't know what the hell the solution is for that, right? I mean, we just continue to deal with this, and it continues to go up, and you have to underwrite it, you have to figure it out, but it has not been a fun process when it comes to the insurance. But the other good part that's starting to happen from an investment standpoint, especially multifamily, is the gap from the buyers and the sellers' expectation around pricing is starting to come together. Before, obviously, if you're a seller, you bought it at a super cheap interest rate, and your number of what you thought it was worth was way up here, and the buyers are thinking everybody's distressed, I'm gonna get some good opportunities, so no transactions were happening. That has started to compress, and just from an activity standpoint, we're starting to see more and more coming back, and optimistically looking into this coming year is gonna get some more action and activity going on the multifamily space, especially, we'll see, we'll talk about 10-year treasuries here in a minute, but especially if interest rates start to kind of come down as well. Office, should we just skip office? It's been a really tough talking one for a while. Actually, I think that office gets a bad rap. I probably shouldn't have started with that one, but in my opinion right now, overall, there's this kind of overall trend around flight to quality that's happening. And if you really peel the onion back in terms of the data around office space, it's not as bad as it looks. So sure, on the cover, 27% vacancy, probably one of the worst around the country. It's not a good feel if you're outside the market looking to invest in. But if you break it apart and you say, just look at buildings that have been built since 2015, that vacancy is actually closer to 10.5%, 11%. The absorption numbers, yes, this slide is gonna tell you there was negative 1.2 million square feet of absorption last year, but Class A, that building since 2015, actually had a positive million square feet of absorption last year. So big picture, you got this group, million square feet, new product, then you have everybody else, which is probably a negative 2.2 million square feet when you bring those two together, and that's what's essentially bifurcating the market around the haves and the have-nots right now. So if you have a very well-located office building, you've got the amenities, and you're willing to put some money in for TI to get and attract a tenant, you're going to be just fine. If you've got some building that's not well located and you're not putting any money behind it, you're going to have challenges, and that's exactly what the office market looks like right now. But from an overall volume standpoint, we still had 12 million square feet of absorbed or leasing activity that happened last year, so still a very robust and active market that I would say is getting a little bit of that bad rap, but it overall is obviously a changing market that everybody talks about. The big thing that we touch on quite a bit is the back to work. So I think I touched on this last year. Castle, which does all of the security card readers and tracks it, they've been aggregating a bunch of data together. And essentially what this chart will tell you is at the far, far left there, that's right before the pandemic happened. That was when that was the stable market where how many people were coming into the office. Pandemic happens, boom, falls off a cliff, nobody wants to go to the office, all these new remote policies start happening, and it starts to trickle up. The good part, and it's probably hard to see with the light green line up there, Houston is the #1 market of all the major markets across the country in terms of people coming back to the office. So we're sitting at about just shy of 70% of what was before the pandemic. And really, when you think about it, if you have a policy that's 3.5 or 4 days a week in there, that's your 80% number. So we're basically back to what probably is the normal. But an interesting kind of stat on this as well from an employment standpoint, obviously the new administration just announced that all government employees have to be back in the office 5 days a week. The city of Houston just made that same announcement last week, so you're going to start to see that. And just from a stat standpoint, 13% of the employment market is government people here in the greater MSA. And so if you get, obviously not all 13% of them are 100% remote, right? So let's just say 3 to 5% maybe are. That number is going to start to trickle back up and is going to get back to normal as well. So there's a lot to come. I think there's a lot of unknowns as it relates to that, but we are definitely starting to see more and more back to work, back to in the office in interaction. It's about the culture. It's about bringing people together and efficiencies with that, and a lot of companies are looking at that. Office construction, that is a very boring map. Wah, 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 3. Kind of looks like my golf game. Ball way left, maybe there's a middle one, but either way, construction activity is slow, no surprise on that one. But I think the really kind of the underlying thing to me is there's a demand for those new product. The buildings built since 2015, they're doing well. So if someone has the courage and willingness to do it, it could work. It's tough, but obviously there is a demand for it. And so we've got the City Center 6, that project over there that Midway's doing. It's going to be a success story. It's well located. It's got the amenities. It's got a proven track record. And so those are the ones that are going to continue to obviously support the office. But construction's going to remain obviously limited. This one also investment, who really wants to buy an office property right now? Probably not a lot of people. And so we've got a deal for you. We'll talk later. But at the end of the day, it is, if you have the right product, if you've got the right tenant mix and you've got the right term, there is obviously transactions happening, and there has been these adjustments. What I want to do almost one of these years is actually kind of bifurcate out the distressed stuff, the good stuff, and really figure out where all of that is falling, because there's a different story as it relates to each of them. And so overall for us, the white line at the bottom, volume, it is still coming down. The overall price per square foot coming down, but 10% of the transactions have been distressed, so it's kind of a no surprise that you see volume coming down. They're buying dirt cheap. They're going to hopefully take some opportunity to fix them up. We'll see what that means with some of them that probably should be just torn down. I mean, at the end of the day, there's certain office properties that should just not exist anymore, but the cost to tear them down or cost to buy and then tear down is obviously going to be a big hindrance. So left to be seen on that. And then we all talk about sometimes the whole conversion of office properties to multifamily. We'll see where that shakes out. It's happened a few times, but that's going to be a real challenge for a lot of developers to be able to do that. All right, industrial. Kind of put this one here is the cooling effect has come, but it sure as hell ain't cold. So yes, we have seen activity from an industrial standpoint start to slow down. But again, going back to the comments that I made before, you're comparing it against an astronomically active market in 21, 22. So where we are at now, frankly, is still above our averages. We would typically see about 10 to 15 million square feet of positive absorption each year before the pandemic. We did 19 million square feet last year. I think that's pretty damn good, right? So just because the headlines might say differently of the slowing down, there's less transactions happening, it's still a very active market. The big difference that I would say is the deal sizes have changed. So back in 22, I think I have it up here, there was over 120 transactions that were over 100,000 square feet. This year we had about 75 to 80. So those are the differences that's happening, which is causing absorption to come down just a little bit. But overall activity around industrial has been strong. And one of the big things with the new administration and tariff talk and all of that stuff that's going on is that 25% of the transactions this past year were from Asian and Chinese firms. So they're coming. The Asians are coming. No. But it is a big push, and obviously it makes sense. Can you get around the tariffs? Can you build here, manufacture here? And obviously from that standpoint, that's a very positive thing for this city. From an absorption, and I put this up last year, I think it's a great slide. I had a lot of feedback from this one, and it tries to break down each of the submarkets and tell you the vacancy rate or the overall absorption that happened, but a percentage of that absorption related to the actual size of that submarket, right? So we can say the north had the most amount of square footage at 5 million. It's obviously very dominating, but when it relates to the size of the north submarket and square footage, it was 3.4%. So the south submarket had 6.2% of the total absorption for its submarket. So it's very active, some new product being built, and obviously being absorbed as well as there. And then the construction, we've got 13 million square feet currently under construction, which is significantly down from what it was in the peak as well. So lots of change, but a lot of activity still going on around industrial. And in the investment side, same song. We had a cliff fall off over the past few years, but now industrial starting to come back up. We're about 2 to 3 times as more growth than the overall U.S. average. And so the trend for overall industrial investment continues to be hot. And there is obviously a huge appetite from lenders and buyers in terms of that. It's just, again, getting pricing to kind of come into a place that makes sense from both the buyers and the sellers as well. Healthcare, I kind of touch on this one. No one is getting younger. Is anybody getting younger in here? I don't think so. I think I am, but it just doesn't work. But overall, healthcare from the standpoint of what's going on, I'm just going to touch on a few things. The big trend here is all of the health systems are smaller, they're decentralizing, they're getting more into the mix with where the patients are, where they live, so that it's quicker and easier access to their care. AI and telemedicine and technology is completely evolving the way that they're all thinking and putting their locations into there. We've all probably used the teledoc and done that. It's a lot easier than having to go to the doctor. And so all of that is essentially pushing it in. But vacancy continues to come down. Absorption's down a little bit, but still very strong. Lots of construction activity still happen. And so from a healthcare standpoint, very active market that we continue to have a lot of positive outlook of that as well. The debt market is probably one of the most confusing and challenging times right now. And so I put this, we're treading new waters in some ways. And so this graph, I think, tells a nice little unique story around, we all know what the Fed is doing in terms of looking at potentially lowering their interest rates for the short term. So they made some contractions last year. And historically speaking, when the Fed does their first reduction of their interest rates, typically the 10-year treasuries would then start to follow suit over the next 100 days. And so if you look at this chart, the gray line is taking all of the years when the Fed essentially started to cut rates at the starting point, and then what happened to the 10-year over that time period. And so typically, over 100 days, you would see the rates for 10-year come down to about 50 basis points to 100 basis points below. Well, here we are in our own little world over here in the blue line where it's gone the opposite direction. So yes, we hear Fed is cutting rates. That is not trickling down, obviously, to capital in terms of getting a mortgage or getting a refi or whatever the case with your properties and buying it. It's actually kind of going up. And so from that standpoint, until we start to see those numbers start to equate out, that's where we're going to get some relief. But where we're at today is probably where we're going to be at for a little while here in this year. So it's a little bit of that, what was the survive till 25, higher for longer, all of those things. With the new administration, they are wanting to see how real these tariff talks are, how real all of that stuff, and that is going to keep this line a little bit higher from the 10-year side as well. So wrapping all of this up from a big picture standpoint, all of the asset types, I love this slide because I think it just gives you a good view of where we think it's at today, where we think it's going. Last year when we had this up here, I had a lot of stuff on the right-hand side. Right, so we were talking about industrial a little bit oversupplied. We were talking about office being a little oversupplied or challenged. And so this year, we've kind of shifted some of that stuff to the left side and more in that recovery phase. That doesn't mean it's great. It just means that it's starting to show signs, as you saw in all of those trends, of coming back and starting to show some activity happening within each of those asset types. And I will tell you the optimism, and I was talking to a few people here, the optimism starting this year has been such higher than it was last year, and I can tell just by all of your faces right now, you're all smiling at me, you're having a great time. It's fantastic, or it could be the drinks talking too, but either way, I think this year is going to be much more optimistic, a little cautious optimism as it relates to how the year will end up shaking out, because there's a lot of unknowns, which is why the Feds have kind of paused on any other rate reduction for a little while. But we do think that at least from all of the asset types, we're much more in that recovery phase now at this point. So with that broken glass, I think it's a perfect segue for me to say thank you to our research team and Patsy and William. I'm not sure where they're at in there, but let's give a round of applause for them, please. I see William back there. I don't know where Patsy is, but a lot of work goes into this. We appreciate your time. And our marketing team, Chris Pagano, Chrissy, Martha, and everybody, Tricia, they spend a ton of time putting together. So with that, I'm going to bring on Mr. Bob Parsley, who is going to introduce our guest speaker for today.
Good evening, everyone, and welcome to Trends 2025. I'm Bob Parsley, Chairman of Colliers Houston, and I have the privilege of introducing our featured speaker tonight. I first met Tyler Mathisen in the spring of 1971. We were both high school seniors and were visiting the University of Virginia. Thus began a friendship that has lasted over 53 years. We both decided to attend UVA and set out on our own paths over the next 4 years. Tyler was drawn to the world of media with a focus on newspapers during his time at Virginia. He co-founded a weekly university paper called The Declaration, as well as being very active in many other university organizations. Following graduation, we ventured out into our own worlds. I returned to Texas and attended the University of Texas Law School, practiced law at Bracewell for just under 4 years, and for the last 42 years, I've been here with Colliers. What a journey that has been. From a very small boutique commercial real estate brokerage firm, I believe I was the fourth or fifth person that Les Appelt hired back in 1983, we have grown to what is today Colliers Houston. I've had the opportunity to be involved as we have grown Colliers Houston into one of the leading commercial real estate organizations in the greater Houston and Gulf Coast area. We have an amazing company with terrific people. Today, Colliers Houston has over 90 professionals and a total headcount of just under 140 people. Additionally, the Colliers organization has become a global commercial real estate leader with over 19,000 people in over 66 countries, and last year generated annual revenue of just under $4.3 billion. As many of you know, I consider Colliers Houston to be my second family. We have a great culture, and it's because of all the outstanding men and women who have worked with us over the many years, many of whom are here tonight. Tyler has gone on to have significant achievements and awards in a variety of media organizations. For over 27 years, he was the news anchor or co-anchor for CNBC, the world's top business news television channel. In that time, he hosted or co-hosted virtually every program that CNBC had in its schedule, and most recently, Power Lunch, one of the network's longest-running program franchises. His coverage credits include the bursting of the so-called tech bubble in 2000, the 9/11 terror attacks, the financial crisis of 2007 and through 2009, and most recently, the COVID-19 pandemic and its profound business impact. As some of you might remember, Tyler was our featured speaker one year during the COVID crisis. And during that performance, or that year, he came to us live from his home in Connecticut. Tyler's also co-anchored the Nightly Business Report, an award-winning evening business news program that's produced for U.S. public television. And he has produced multiple one-hour documentaries for the CNBC network. Before joining CNBC in 1997, he spent 15 years as a writer, senior editor, and top editor for Money Magazine. With all of his successes, Tyler and I have one other thing that we have in common. We both graduated with a degree in government from the University of Virginia. The only difference was that Tyler graduated with distinction. I simply graduated, luckily. Despite Tyler's rise to fame in the media, he has continued to stay in touch with many of our old friends, several of whom are in the audience tonight. This is Tyler's 4th time to join us as our featured speaker at Trends. I don't believe that we have gotten more positive responses from our audience than when Tyler has joined us to discuss the world we live in today, from recent presidential elections to the rapid changes that are occurring in both the financial and political world. I'm thrilled to have Tyler and his lovely wife, Jo, join us tonight, and I look forward to hearing his comments on the world today. Ladies and gentlemen, my good friend for over 53 years, Tyler Mathisen.
Bob, thank you very much. I did indeed speak to you all about the last time I was here. It was in the middle of the pandemic. I think most of you have been day drinking heavily, by the way. I couldn't tell. It was all, of course, via Zoom or whatever platform it was, but it was a good time to be here. Bob, thank you very much. And it truly is a wonderful measure of our friendship that we have known each other for 53 years. And at least 3 other gentlemen who are here today I've known that long as well. Ken Humphreys, Tom McNerney, Rich Sheehy. Gentlemen, congratulations on being great friends. I appreciate it. It's wonderful. It's a great sign. I don't remember, Bob, actually, by the way, being a founder of the Declaration, the newspaper at the University of Virginia. But don't worry about it. There's a lot I don't remember about what went on at the University of Virginia, given all that I was doing there. Let's give another round of applause to Kendall and Deck My Room. What a wonderful charity that is. It is great to be back with so many of you whom I've met here before and to make new friends this time around here in Houston and at this signature Colliers event. It's also great to be here in Houston, the winter wonderland of Texas, or as it's now called after last week's snow, Aspen on the Buffalo Bayou, or maybe just Buffalo. How about that? I don't actually live in Connecticut. I live in New Jersey, the home of the drones. And where I live, when the snow falls, it makes everything prettier for about a half an hour. Then the aggravation sets in, the mood fades, and in fact, most of our good moods in New Jersey last only about a half an hour. Be forewarned, ladies and gentlemen. The snow gets dirty, it melts, it turns gray, then it freezes and turns to ice. The ice, of course, can be dangerous. But think of it this way. If the climate keeps going the way it is here in Houston, soon there will be free ice skating on the Gulf of America. By the way, I looked to the back of the room a few moments ago, and I think he may have moved, but there was a handsome gentleman who looked a hell of a lot like J.D. Vance. J.D., you're not here, are you? I don't think so. I don't know whether it's that guy. Yeah, it's nice stubble going. Anyway, I'm truly delighted to be back for this, the 4th time Bob has included me at this very jovial event. It is so jovial, of course, because Bob, and I gather most Texans, have rather liberal ideas about when to open the bar. It may be the only thing that Texans are unitedly liberal about, but if you're going to be liberal about anything, be liberal about when you open the bar. At this event, the bar is open about an hour before the speechifying begins, and better yet, it stays open throughout. If you want to go back and get a drink while I'm up here, I invite you to. The speech just gets better and better and better the more lubricated you get. The fact that the bar is open is a great advantage for a speaker. You know that every speaker's dream is to light up the room, and well, that is much easier when the room is already half lit. As I said on a prior occasion, I'm both flattered and humbled to be invited back, and this is no exception. Flattered because it means that I may have said some things that made at least a little sense. Humbled because quite a few of you were well into your third drink, so the bar for making sense was rather low. I'm sure you know that old saying from Dorothy Parker, the writer and humorist, about third drinks, specifically martinis. First martini, you're under the influence. Second martini, you're under the table. Third martini, you're under the host. Now, I asked my wife whether I could do this line here, so officially I'm throwing her under the bus. I realize it's the Houston Country Club. We have to be a little careful. Anyhow, tonight I'm going to talk a bit about the economy here in the U.S. and globally, the markets, and how they may perform in 2025, some of the known unknowns, and boy, we got hit by one yesterday, that we face. But the more prominent ones probably of those known unknowns are tariffs, China, the effects of AI, and finally some hopeful thoughts about the American future. I mentioned the word humbling a moment ago, and humbling is the feeling you get when you go back and you look at the previous speeches you gave at this Colliers event. I've been doing it now 8 years ago. That was the first one, 2017, January, and I said back then that the economy would grow between 2 and 3%. It did, so I got that right, and I was on target when I said it may be better in 2018. It was. But in 2017, I underestimated how well stocks would perform in that first year of President Trump's first term. I was concerned, overly concerned as it turned out, not about President Trump, but about the fact that there was just too much positive consensus baked into stock forecasts. When everyone on CNBC or everyone in the commentariat is saying the same thing about what might happen with stock values in the economy, that's when I think you want to move the other way. So I was concerned that there was too much positive consensus baked into the stock forecast, and I was wrong. Stocks rose 22%, including dividends that year. When I came back in 2019, I was much more upbeat. I didn't buy the recession talk, even though 3 out of 4 economists at that time were calling for a recession in 2019. And while trade tensions did grow and tariffs were put on China, a trade war didn't happen. And I don't think one is going to break out this year either. I'll give you more on that in a moment. My thoughts about stocks in 2019 were positive. The Fed had basically taken interest rate hikes off the table, and it was the third year of the presidential election cycle, typically the best of the 4-year term. But I sure didn't think the S&P 500 was going to rise 31% or the NASDAQ 35%. Once again, I was too timid. In 2021, we did the event virtually, as we mentioned, and maybe even at midday again, I couldn't tell how much day drinking you all had been doing, but one thing was certain: the economy was drunk on stimulus money in that year, and the Fed was spiking the cocktail with lower interest rates almost down to zero. I thought a good year was in store, and it was. The economy was recovering, and fast. I thought 15% equity gains were highly possible, but again, I was too timid. The S&P plus dividends that year up almost 29%. Do you see a pattern taking shape here? Tyler the timid. So that brings us to today, and I've got to tell you, I am pretty doggone optimistic, which is probably a good reason for you to sell everything and short the market. So will my streak of underestimating stocks continue, or will this be the year my optimism, my uncharacteristic optimism for a guy from New Jersey, gets the better of me and something happens to make my prediction of 10% or better stock market returns look wrong? Let me begin with a couple of disclaimers. I am a financial journalist, not a political analyst or commentator. I am not an opinion guy. At the same time, today, many, if not most, economic stories, trade, energy, and the environment, healthcare financing, drug pricing, the cost of regulation, cyber defense, AI, they are political stories too. And of course, many political stories, from immigration to income inequality to tax cuts to tax equity, are either rooted in economics or have profound economic consequences. You simply cannot talk about the economy and economics without lapsing over into discussions of politics and vice versa. All I ask as I go through the next few minutes is that you maybe turn off your political ears, as my friend, the money manager Michael Farr says. When I say tariffs may be inflationary, or that deportations could disrupt labor markets, I am not being anti-President Trump. I am trying as best I can to call the policy consequences as I see them. And remember, in matters of policy, the most extreme outcomes for ill or good rarely come to pass. Second, I like to think of myself as a common sense moderate. Despite my Northeastern media credentials, I am a pro-capitalism, free enterprise favoring 40-year business journalist who believes that the quest for success and the fortune that can follow it is a noble calling. It is to me at the heart of the American dream. Trying to succeed and make money while doing it is a good thing. It propels the economy forward. So is tax policy that lets you hold on to more of what you earn. Moreover, history tells us that capitalism globally and American capitalism in particular has proved its worth in providing the greatest prosperity for the greatest number of people. And the freer the free enterprise, the better. Not no regulation, but not reflexive ideology-fueled regulation or deregulation either. So what explains my more optimistic view as we head into 2025? Well, one thing is that I don't want to be too timid again. I don't want to be timid Ty this time. Second is that the global economy is okay enough, and the U.S. economy is even better. It enters 2025 with real momentum. Growth is solid and is likely to remain so. Danny talked a little bit about what he's seeing here in real estate. I think you're seeing similar, and the health of the consumer, you're seeing similar effects in all cities, not all necessarily, but in most cities across the country. Growth is solid, likely to remain so. Jobs are up, unemployment down, hourly earnings up, inflation down, energy prices manageable, housing prices maybe not so manageable, interest rates lower, though we will see tomorrow whether the Fed will follow the president's wish spoken at Davos last week to drop them even more. I kind of doubt it. I think interest rates are going to stay a little bit higher for longer, and the Fed is going to be very careful about rushing to lower interest rates in 2025. But stock prices reflect these fundamentals: a good economy, interest rates that are lower, inflation that is approaching the Fed's 2% target. The S&P 500 entered the year on a roll, up 25% last year with dividends included. It hit 57 new all-time highs last year, the most since 1928. That momentum is still in place despite yesterday's market shudders. The reason is pretty clear. The new boss in the White House is the same as the old boss, only stronger, and with majorities in both houses of Congress. That new boss, says Michael Kelly of Pine Bridge Investments, is a radical capitalist. He says it's going to be a very, very pro-business, pro-capitalist kind of remove all the obstacles type of setting. It's going to be let it rip economically and politically. Markets like that. Indeed they do. So do the billionaires, especially those formerly progressive tech bros who surrounded President Trump at last week's inauguration. Irony. Again, turn off your political ears, Thanks in large part to the new business-friendly president, I think the table is set for double-digit stock market returns in 2025 and a better-than-good economy. That's not to say that it's going to be a smooth, easy path to that outcome. I don't think it will be. And yesterday proves that the market is very vulnerable to headline risk. It's also subject to political risk from a president who embraces disruption. But remember, we elected this president precisely to disrupt. He is also a president who revels in confronting friends and foes alike. Bottom line, a much more volatile year for stocks. The president's tariff threats are certain to be unsettling for stocks from time to time, but he's already stepped back a little. He did not, for example, put 25% tariffs on Canada or Mexico on day one, or 10% tariffs on China on day one. In fact, last Thursday he said he would, quote, rather not use tariffs against China at all. It seems like he had a good chat with Xi Jinping before he took office. Now, he might impose tariffs on those big three trading partners on February 1, as he's hinted, or wait until his trade team gets back to him after studying the situations and making recommendations by April 1. And even then, I suspect he will be selective as to how high any tariffs will be, on which products they will go, how long they will last, and how conditional they will be on achieving the objectives he seeks. To be clear, I do think some tariffs probably will hit China, Mexico, and Canada. He can't back down fully on that. Others are likely to hit allies in Europe. Still others will be used to redress grievances the president sees, as was the case with Colombia earlier this week. Simply put, the president likes tariffs. First time William McKinley's been mentioned in a presidential inaugural address in my 70 years on this planet. McKinley, like President Trump, loved tariffs. For President Trump, they equal leverage, and deal makers love leverage. For another, he is going to need the revenue to help pay for the tax cuts he wants to extend or expand. And I do think 2025 will see the Trump tax cuts largely extended. That is another plus for the economy and for the markets, but maybe not a plus for those who would like to see the deficit drop. Bottom line on tariffs, I think they, or the threat of them, will upset the markets episodically this year. They're going to be a recurring theme, but I'm not betting on trade wars that bring big inflation or an economic crisis. I will concede, however, that all this is a bit of a wild card. While I do think stocks will do well this year, remember, too, that we're coming off back-to-back years of 25% gains for the S&P 500. Expecting a third one is asking too much. That's because stocks are expensive, even after yesterday's pullback. Right now, S&P 500 valuations, a measure of the expensiveness of stocks, are high, 21 times expected 2025 earnings. The 10-year average is much lower, 18. Now, that multiple can make short-term gains, even medium-term gains in stocks, harder to come by. It's a headwind for equities this year. Your starting price matters a lot in what your final ultimate return is. But note this, those valuations are so high because of the priciness of those stocks known as the Magnificent Seven. You probably know them: NVIDIA, Meta, Tesla, Amazon, Alphabet, Apple, and Microsoft. They are still expensive despite yesterday's big sell-off in many of the tech names, and especially in NVIDIA. Together, those seven account for over a third of the S&P 500's total value, and they trade at price-to-earnings multiples of 30 or more. Take them out of the equation, and the valuation of the S&P 500 is closer to its long-term average of 18. Moreover, the fabulous 493, that is the non-Mag 7 stocks, are likely to see their earnings expand by a lot this year, even as the Mag 7's profits decline, or their profit growth declines. And yesterday's news about DeepSeek, a potentially low-cost Chinese competitor to the AI incumbents, puts further pressure on the Mag 7's earnings growth prospects for this year. So if I had fresh money to put to work this year, which I don't, the non-Mag 7 stocks in healthcare, consumer staples, finance, even energy and utilities, and yes, maybe even real estate, may be the better place to hunt for values this year. Or consider an equal-weighted S&P 500 index fund, that is one that is not over-influenced by those 7 super caps. Remember, though, before you do anything, do your own research and consult a financial pro, which I most definitely am not. Quick word on 2 other things I think tee up 2025 as a decent year for stocks. One is corporate earnings. They are estimated in the aggregate to grow 14% this year. Stock prices tend to track corporate earnings, and it's likely that rising productivity and improving margins will lead to better corporate profits this year overall. And where's that rising profitability going to come from? Well, one place is surely artificial intelligence. Now, I'm not smart enough, and we don't have time enough to discuss whether AI will be a great thing for society or will lead to its ultimate demise. But what we can count on is this. There's going to be a lot of capital spending pouring into AI this year and in future years as far as the eyes can see. Just last week, Mark Zuckerberg said that he and his company Meta will spend $60 to $65 billion on AI this year. That's one company. And every single company of scale is going to spend something on AI this year. Microsoft, which reports its earnings tomorrow, has already said they're expecting to spend $80 billion in capital spending this year. That's another company, just one. And then in one of his first economic initiatives, the president, flanked by Sam Altman, Larry Ellison, and Mathisen of Japan, announced a $500 billion investment in AI called Stargate. Yes, the president does want to go to Mars, but this is a maybe even bigger moonshot on AI. The president rightly wants the U.S. to dominate AI, and that's what it is doing now, and what Palantir's chief Alex Karp, a guy at the very top of the AI food chain, says it will do for years to come. China's DeepSeek is a Jason Verlander fastball, right up high and tight. Now, I know Verlander went and signed with the Giants. You all are sore about that. I get it. I understand. But I'm happy to see him out of our league as a New York Yankee fan. Anyhow, NVIDIA was threatened yesterday. Lost 17%. Worst day in 5 years. $600 billion in market value of that company alone went poof. That is more market value than the total value of Exxon, Costco, Bank of America in one day, a record. Came back today by about 8%, erasing some of that loss. A host of other chip makers also got smacked. So did some of last year's derivative AI winners, from the builders of data centers to power companies. Last year's second-best S&P 500 stock, Vistra of Dallas, fell almost 30% yesterday. Constellation Energy, about 20%. It's unclear exactly what DeepSeek means. And also worth pondering is how welcome a Chinese AI company will be in a country that is struggling to figure out what the hell to do with a company like TikTok. That seems relatively innocent compared with what a Chinese AI company could mean if its software is broadly deployed through app stores like Apple's and Google's. It's also hard to predict how quickly the productivity boost from AI is going to start to show up in corporate or economic numbers, but it will, just as it did from the internet and mobility revolutions a generation ago. Finally, let's spend a moment on China. Already it seems that the president and China's Xi Jinping are more interested, it seems, in consultation maybe than confrontation. Maybe that's to be expected with a new administration, but let's call it welcome for now. It may not last, but it's better than the alternative, and the president may even go to Beijing soon. And if he does, he will be carrying a strong hand. The U.S. economy is inarguably the world's strongest among large nations right now. He's got a political mandate at home. And in China, the economy is not the juggernaut it once was. Far from it. The China expert and veteran Asia dealmaker Dennis Unkovic says China will be lucky if it reaches the 5% growth rate projected by Xi Jinping for 2025. Unkovic calls China's economy poor. Think about this. You all know a ton in this room about real estate, and about a third of China's GDP is tied up in the property sector. Millions of housing units in China are vacant, empty, and cannot be sold. Big real estate companies like Evergrande and others have really suffered. Some are failing, others will. Prices are declining. About 70% of Chinese household savings is in illiquid real estate, and it's no wonder then that Chinese consumers are on the back foot. China's debt to GDP ratio is even worse, believe it or not, than ours, and that is saying something. They've got a multi-trillion-dollar problem and no quick fix. So the president has leverage, and you can bet your ass. Can I say that here? Bet your ass. Say that here. All right. You can bet your ass he's going to use it. I expect the friendliness of the past 2 weeks will chill a bit. The president will insist on getting things he wants on trade, fentanyl, maybe even on TikTok or other national security interests. He won't get everything, but I suspect he will get enough of them to claim a big win, just as he did with Colombia over the weekend. Maybe that was a little win, but little wins pile up too. The president promises lots of economic wins, and I hope he's right. We all do. His economic success will be our success as well. And he is surely the most business-friendly president we have had in a generation. But I'm no surer than you are how, where, or when those wins will come, or how they'll be offset by the inevitable challenges ahead. I've given you my best thinking about 2025, but I caution you that predicting what will happen in any single year is full of risk. Just think back to 2020 and COVID. No one knew that was coming. There may be something coming around the bend that we can't anticipate today. So this intrepid forecaster is also, again, a humble one. There's that word again, humble. But what I'm not humble about is this, my faith in America. If you bet on America, over time, you will be rewarded. What happens in any 1 year, or really any single 5 or 10-year point-to-point period, is a crapshoot. But time and America's singular skill at reinvention, not to mention the ingenuity and drive of its people, almost always has meant that patient investors who put money in the American economy will end up far the richer for it. So, be humble but confident. Bet on America. And above all, remember what happens after that third martini. Thank you all very much. Thank you all. I'm happy to. Sure.
So we're going to open it up for questions for a few minutes if anybody has any questions. I mean, he did a really good job.
Martini.
I
don't drink.
I got a great question. I need you to pick a number between 1 and 10.
You want me to say it?
Yes, say it out loud.
6.
Who's got the lucky snowball number 6?
Lucky Snowball.
Hey!
Yes,
oh wait.
I knew it was you.
Oh, you got it. We're going 6 back there. You can't win, Patsy. Come on. All right. Any questions? All right. We got one question in the back.
Sir. Bitcoin. I wish I'd bought it. I wish I'd bought Bitcoin a long time ago. It's one of the few things that at CNBC we are actually allowed to buy. We cannot buy individual securities, corporate securities, stocks, bonds, things like that. I think Bitcoin, I'm not sure what Bitcoin is ultimately going to be or what its ultimate value is going to be. It is clearly a wonderful speculation. I think it was above 100,000 again today, 101,000, something like that. And the president is a big believer now in cryptocurrency. And he is going to put in place at the SEC and the SEC's enforcement divisions people who similarly want to see the United States become a crypto powerhouse. So I think as a small percentage of one's portfolio, I think Bitcoin would be a good place. But it is a very speculative thing. I think you can expect, if you can tolerate the volatility, I say go for it. I'm probably going to put some money into it myself. I'm not sure what it does. I'm not sure what use case there is for it, but I think it is probably here to stay. I'll take a couple more if you got them. Yes, sir. Auto industry. GM going to Mexico is where it's going. He asked about the auto industry and where it's going. GM, not a good report yesterday. Lost a ton of money, down a lot. I think the auto industry ultimately is going to become a business with steady returns, but not spectacular returns. My guess is that the move, not because of policy, but because people increase, I think the electric vehicle industry will grow a lot because the electric vehicles will get better and better, and they will begin to show their value as a mode of transportation in a way that they haven't so far. I have an electric vehicle. I have a Tesla. I like it. I don't love it. Its range, they tell you get 320 miles on a charge. It's horse crap. It doesn't do that. But overall, I think the industry is going to do okay. I think foreign badge cars built in America. And so those workers will find work. It's going to be different, and artificial intelligence and the engineering that's going to go into these things is going to cost jobs, but then I think ultimately it might add jobs. Take one more in the far back. Media companies. Will media companies shift their money? Well, the better question to ask is what money? Because the media companies aren't doing very well right now. Most of them are in distinct cost-cutting modes because, well, the legacy media companies, I should say, the legacy media companies are in distinct cost-cutting modes because the audience has migrated elsewhere. Media is what you have in your pocket today. Media and advertising is increasingly going that direction, and if we've learned anything over the past generation, it's that the large incumbent media companies don't do new media very well. They just don't. The Metas, the Netflixes, and others do media better than the NBCs, than the Discovery, Time Warner Discovery, than Paramount. So the media companies are going to face a very challenging landscape. And some of the names that we grew up on, I don't believe will exist in another decade. I think they'll be absorbed by by entrepreneurs who are deep-pocketed, or by other large companies, whether it's Netflix or Amazon or Apple or others. So I'll tell you a personal story. Our son applied to Indiana University. He applied to the media school there, and he got in. And then we told him, "Don't study media, son. It sucks. You know, go into something that's actually got a future, like business or sports management or something like that." So I'm worried about the media business. I hate to see it happen. I worked for many, many years at Time Incorporated, which was the most powerful, largest magazine publisher in the world. It doesn't exist anymore. It got sold, it got broken up, it got spun out of Time Warner, it got sold, it got broken up. It and most of its properties don't exist anymore. And so it would not surprise me to see this very same thing happen to some of the incumbent or legacy media companies that we are so familiar with. Answer your question? Yeah. All right, timid tie on media. All right, ladies and gentlemen, the bar is open. Thank you.
Thank you again. Thank you. I mean, he wrapped it up. Bar is open. Have a good time. Thank you all for coming, and thank you for your support as well. Make it a great year. Thank you. As you all know, every year, part of this event, as well as what we do at Colliers Houston, is a charitable fundraising event with our golf tournament that we're going to be hosting here in a few months. We've spent a lot of time working on this, and every year we go through the process of raising money to give back to a local charity. And our big focus on that has always been a charity that the money that we contribute is going to make a difference, right? The Red Cross does a great job. United Way does a great job from a broader scale. But we want to contribute to a local group that has impact here locally, and the money that we raise goes directly to them. So last year, we partnered with the Arbor School. We raised $55,000 for the Arbor School, which was I think one of our all-time records in terms of fundraising. And it went to a great cause with the Arbor School. And so before I announce our 2025 partner, I do want to go ahead and recognize all of our partners, our underwriters, and our sponsors that take the time to obviously continue to support us in this endeavor with our charity partners. So Able Design Group, Agile Interiors, Mailing Group, Brown & Brown, Garrison, Granite, IAG, Lane, O'Donnell Snyder, South Trust, Title Houston, Wilson Cribbs Gorin, E3 Electric, Gallant, Riverway Title, J. Tyler, Stellar Bank, Urban, Weiser Engineering, and WMG Development. Can we give a warm round of applause to all of these people, please? And obviously, we wouldn't be able to do what we do without your help. So again, thank you for your contributions and time with that as well. So with all of that being said, I'm super excited to announce our 2025 charity partner. And this group does a good number in terms of kind of the children's side and the heartwarming side. And if you ever think about a kid that is spending long-term in a hospital, it's not a fun experience. So this group, which we're excited to announce, Deck My Room, what their whole focus is on making that experience for these kids that are staying in these hospitals long-term as much as it can be happy to get that one smile out of those children. So today we've got Kendall. Come on up, Kendall. Yes, give a round of applause. And Kendall's going to give a little quick overview. We're going to watch a video, and then we'll go on with the program.
All right. Good evening, everyone. My name is Kendall Plank. I am the president and co-founder of Deck My Room. I want to start by thanking Colliers, the sponsors, and everyone in this room tonight that has contributed to Deck through this golf tournament. You have no idea the impact it will have on our organization and the kids we do it for. Deck My Room was founded with the child's healing process in mind. Our goal is to create cheerful, homey spaces for these long-term kids as they undergo treatment. I'd like to share a short video with y'all about what Deck is about.
Deck My Room is all about decking hospital rooms for children that are there for a prolonged period of time. We transform the room from being a boring white hospital room, which can be quite scary for children, and we transform it into what their requests are, whether they like Toy Story or football team or whatever it may be. We transform their room into their own personal room, and then they take everything with them when they go home.
Deck My Room started, we had a friend in Austin call us and tell us that they had a friend that didn't know anybody in Houston. He was coming in for his second bone marrow transplant. My mom was heavily involved already at Texas Children's here in Houston, and they asked if we could do something special for him, and we thought about it, and we found out his favorite thing was UT football and all UT, everything burnt orange, and we decided that we were going to decorate his room. We got together with the hospital and they allowed us, and realized it made a very big difference in his healing process.
First of all, we didn't know that this was going to flourish the way it did. And when we saw the look on that little boy's face and how excited he was that somebody actually cared, it was quite an experience. That's why we decided that we have to do this for all children that are there for a long period of time. And that's the most important thing. It's about giving back. We've taken off, and that was 16 years ago. Now we have a small staff here in Houston, and we have 11 directors around the country, and we have one national director. And we've decked over 600 rooms last year, and we're going to well exceed that this year. As of now, we're at 130 hospitals around the country, and we all started out with the one.
We never in a million years could have dreamed that. But we thought Texas Children's, this would be great, it's local for us. And now look, from 2007 to now, we are in 130 hospitals and counting.
We train our volunteers, we background check them and everything. So, and they also wear aprons that say, this is Deck My Room coming in to deck a room. And it's been incredibly successful, and it's just traveling like crazy now.
I love this so much. Thank you.
When they see us coming,
Yeah,
they know.
they know.
Oh my God, here
They
comes
know.
Deck My Room. And we always
They
have
know.
a sign that says, you know, on their door that says, you've been decked. So when the child goes home, he or she takes everything with them when they go. So it's all theirs. This is all donations. And we depend on donations for these rooms. The future for Deck My Room is to decorate every hospital room where there's a child in need, you know, that's there for a prolonged period of time. That's our goal. This program isn't about us, it's all about the kids and how important it is to create a healing place for these children that are in the hospital for a prolonged period of time.
Thank you, guys. My mom and I started this 18 years ago now. This video is actually 2 years old, with a single room at Texas Children's. I was 11 years old when I came up with the concept of Deck. We want to do this for every pediatric patient that's in need of this. I mean, it really makes a difference. We're doing, one hospital at a time, if you will. So 3 years ago, when this was taken, we were at 130 hospitals, and we decked about 600 rooms a year. And now we're at over 185 hospitals. And this year alone, or this past year, we decorated 2,300 rooms. Our volunteers personalize each room with the patient's favorite things. They shop and select each item to create a comfy, cozy, healing place specific to the patient. Then, when they go home, everything is theirs to take with them. We spend up to $300 a room. 2025 is going to be an even bigger year for DEC, so we have 11 hospitals right now waiting for us to start our programs, and we are projected to surpass 2,500 rooms this year. Our goal is to continue growing and creating healing spaces for all long-term pediatric patients. If you're wondering how you can get involved, there are several ways. We always need volunteers to help us decorate more rooms, and we rely on donations, grants, and fundraising to make this possible. We have also 2 upcoming events here in Houston. One is our Ladies' Luncheon, that is on February 12th at Tootsie's, so coming up. And the other is our biggest event every year called Kick Up Your Boots, where we bring in top country talent and have a fun time and 2-step and everything and raise money for these kids. And that will be on October 9th at Bayou City Ballroom. So you can find all of our information on deckmyroom.org. But thank you guys again. The support means the world to us, and we really appreciate it.